Okay, let's unpack this. We're diving into a real paradox that's kind of defining the U.S. market right now. It's October 2025, and yeah, the major indices are hitting these incredible new highs. All the talk is euphoria, but when you zoom out a bit, the foundations under that peak look, well, honestly, pretty shaky, incredibly precarious.
Exactly. That's a perfect description. Precarious euphoria. And our mission for you today in this deep dive is to look at how we actually got here to this very concentrated summit. And maybe more importantly, we really need to shift the focus away from just chasing momentum, towards proactive risk management.
Right. And the spark, the actual trigger for this latest surge, it seems so specific. It was a September 2025 CPI report. The headline inflation number came in at 3.0% year over year, which, okay, was just a tiny bit below what everyone expected, like 3.1%. Barely anything.
Yeah, just 0.1%.
But the market saw that sliver of difference and basically treated it as this definitive green light.
It pretty much sealed the deal on policy speculation, yeah. Instantly, you saw market participants pricing in, almost a 99% chance of a rate cut, a 25 basis point reduction at the next FOMC meeting.
Wow.
And for anyone less familiar, 25 basis points, that's a 0.25% cut. The FOMC, that's the Fed group deciding U.S. interest rates. So this whole rally, it's fundamentally fueled by this bet on cheaper money coming soon, not really on strong economic growth.
Okay, but here's where it gets really interesting. The weakness that's kind of lurking just beneath that headline number, this market high, it's dangerously narrow, isn't it? Most stocks are actually, struggling.
That's exactly right. If you look at the S&P 500, the median stock, the one right in the middle, is still down, 19% from its own peak? 19%.
That's huge.
It is. And that concentration metric, that's the alarm bell you should really be listening to. If we strip out the performance of just those magnificent 7 tech giants, the S&P 500's return for the year shrinks dramatically. It goes from that impressive 14% headline number down to just 8%.
Only 8%. So the rest of the market is basically treading water, or worse.
Pretty much. And while 8% might sound okay in isolation, it points to really unhealthy market breadth. I mean, if only a handful of companies are driving all the gains, your portfolio is way more exposed if something hits one of those companies, regulatory, financial, whatever.
And while these stocks are soaring, we're seeing signs of pretty deep financial stress popping up in the credit markets. Specifically, this area called the private credit market, what people often call the shadow banking system. And maybe for the listener, just quickly, that means lending that happens outside the usual regulated banks.
Exactly. And we are seeing some serious cracks appear there. You've got these high-profile bankruptcies. Tricolor, for example, that was in subprime auto loans. And the collapse of First Brands, which involved complex structured products. These aren't small things. They matter because they show stress in the less transparent, maybe more opaque parts of the financial system. What's particularly worrying, I think, is the reaction from top regulators. Bank of England Governor Andrew Bailey, he explicitly warned these events have, and this is quote, worrying echoes of the subprime mortgage crisis.
Wow. He actually used that phrase.
Yes, pointing specifically to complexity, weak underwriting standards. Stuff built up during all those years of easy money.
It's almost surreal, weak underwriting standards. Again, feels like we just went through this less than 2 decades ago. History repeating. So, okay. Given this whole paradoxical situation, what does this actually mean for you, the individual investor listening right now? It sounds like the strategy needs to shift, immediately towards protecting capital, fortifying the portfolio.
Absolutely. That's the imperative now. And it means tackling that concentration risk head on. If you're overweight those big tech names that have driven everything for the past few years, it's probably time to trim those positions. Seriously, think about it. And then implement a clear defensive tilt in your stocks. We're talking about shifting towards more resilient sectors, utilities, consumer staples, that kind of thing.
Okay, defensive sectors.
But, and here's the really important nuance, you have to prioritize companies within those sectors that have low financial leverage, low debt. Look specifically for things like low net debt to EBITDA ratios. Because, look, In a real credit crunch, even a normally stable utility company can get into deep trouble if its debt load is too high.
Makes sense. And beyond stocks, reallocation should probably include some actual safe havens, right?
Definitely. Must include them. Gold, for instance. It's done exactly what you'd expect it to do in this environment. It's surged over 50% just in 2025 alone, hitting record highs above $4,000 an ounce. That's clearly driven by all this uncertainty. And then your portfolio anchor should probably be intermediate U.S. Treasury bonds. We emphasize intermediate, think generally 3 to 7 year duration bonds. They offer probably the best balance right now. They give you strong hedging power if the market really tanks and everyone flees to safety, but they minimize some of that direct interest rate risk you get with the really long-term bonds, which can be much more volatile.
Okay, intermediate treasuries. Got it. So let's wrap up with a final thought for everyone to sort of chew on today. Kind of pulls this whole discussion together. The market is currently celebrating these potential rate cuts, right? Because, hey, cheaper borrowing costs are good, but those very cuts are likely coming because the economy is weakening underneath. And that underlying weakness is exactly what's stressing out the private credit market we were just talking about.
Precisely. And that raises this really important, almost paradoxical question for you to consider. How might the market's perceived solution, these lower interest rates, actually make the fundamental problem worse? Cheaper money often fuels, let's be honest, irresponsible lending, especially in those less regulated shadow markets. So if the Fed's medicine just enables the next, maybe even bigger wave of high-risk, poorly underwritten loans, well, it could create this really dangerous feedback loop, a loop that could completely overwhelm the equity rally eventually. And that is the true risk you really need to be focused on managing right now.